Hello everyone. This is Lwazi Kumbi, your mentor. Hope everyone is good. So we are back again with lesson two, guys. Introduction to Forex trading. Yesterday we busy with lesson one. So let's get right on it without wasting any time. Here we'll be talking about how a Forex trade works. So basically here what it says is Forex trading always involves two currencies. The base currency is the one you are buying or selling, and its price is given in the code currency. So the base currency is the one. So we are looking at the context of Euro USD. Those are two currencies which are called a currency pair. So the one on the left is the base currency, which is the euro, and the one on the right is the code currency, which is the USD. So one euro cost 1.05 US dollars. So um, so the base currency is a euro, the code currency is the USD, and one euro cost 1.05 US dollars. I hope you understand that. If you don't, please leave a comment below so I explain it further on a different video. But it's as simple as it states here. The left one is the base, the right one is the code currency. So let's move on. We are currently working with Euro USD, which is a currency pair. So let's say you have anticipated that the markets will go up, which means that euro is strengthening in value and the USD is weakening. You will basically be buying the euro and selling the USD. Okay, let me explain that further. If the market is going up in the context of euro USD, it means that the euro is strengthening in value and the USD is weakening in value. If the market was going down, then the euro is weakening in value and the USD is strengthening in value. Therefore, if the base is strengthening in value against the quote, you will always buy that market. And if the base is weakening against the quote, you will always sell that market, meaning that you always buy the currency that is strengthening in value, and you always sell the currency that is weakening in value. I hope you guys understand that. So let's just look at this blue and orange example shown here on a random chart. So here you can see that at a level of 1.0500, we are looking at euro USD. So here on the blue side, we have anticipated that the markets will go up. That means that we are buying euro and we are selling USD because euro is gaining strength in power, in value, I mean. And we are selling the USD because it's weakening in value, you know. So and then the orange parts, which is the 1.0525 level, is 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 the closing price, meaning that now you are anticipating that the market from here will be going down. So when we close the market here, we are basically selling the euro and buying the USD because we are anticipating that the euro will be weakening and the USD will be gaining more strength in value. Okay, let's move on to margin. If you, I think I've explained everything here. If you guys don't understand, please leave a comment so I explain it further. If you still don't understand it in a different video. But here, what I can conclude is that in the context of Euro USD, if the market is going up, it means that the euro is gaining strength. If the market is going down, it means that the euro is losing strength, you know, and the USD is gaining strength. Okay, so let's move on to margin. Margin, which is also called leverage. Margin is money borrowed from your forex broker. Leverage amplifies price changes and thus the profits or loss from a given trade. So what this means is that here margin allows you, a broker gives you money from your initial investment. So let's say um, you have chosen to work with the margin of 1 is to 1,000. 1 is to 1,000. So here, and you have deposited an amount of 100 USD. What the 1 is to 1,000 means is that you can open positions or open trades that as if you are trading with an account that has 1,000 USD in it, even though you have deposited with 100 USD. I don't know if you understand me, but if you have deposited 100 USD and you have chosen a margin which is 1 to 1,000, that means that you can open um, trades as if you are trading with an account that has 1,000 USD. So meaning that you are trading with money you don't have, of which there's advantages to that and there's disadvantages to that. The advantages is that you are able to open more trades, which means you have room to make more money in a short period of time. But the disadvantages is that you can easily blow that 100 USD in a short period of time because you are trading with more than what you have. Okay, so it's almost like a loan, yeah, if you can put it that way. And then there's what we call bulls and bears. Bulls, the market is going up. You think bull bull you think bullish, which is similar to bulls, you think a currency will rise, you buy the currency, you take a long position. This was what was explained in lesson one. And then bearish is the same as bears. You think a currency will fall, you sell the currency, you take a short position. So bulls, the market is going up, bears, the market is going down, which is similar to bullish and bearish. When you trade Forex, you have the choice between buying or selling a currency pair. When you buy, you are said to be bullish. When you sell, you are said to be bearish. It's as simple as it puts itself here. So when the market is going down, you are said to be bullish. When you sell, when the market is going down, you are said to be bearish. Okay, let's move on to the next topic. Who trades Forex? The Forex market is enormous in size and is the largest market with millions of participants. This was also covered in a topic on in introduction lesson one. Hundreds of thousands of individuals like us, money exchanges to banks to hedge fund managers, everyone participates in the Forex market. Okay, when can you trade Forex markets? Forex markets is open 24 hours a day and 5 days a week. However, it does not mean it is always active. Let us check what a 24-hour day in the Forex world looks like. Okay, which will take us to the next topic, which is the Forex market hours. Okay, the Forex market is divided into four major trading sessions: the Sydney session, the Tokyo session, the London session, and the New York session. So here I will unpack Forex trading sessions and explain everything you need to know in the four timelines, which is the Sydney, the Tokyo, the London, and the New York. While the Forex market is open 24/7, 5.5 days a week, there are periods where there is constant volatility and periods where nothing much happens. So what they refer to when they say consistent volatility, it means that the market is moving like crazy. It's where it's most active. Understanding the trading sessions and the best times to trade is important for any forex day trading strategy, or any forex trader, or any other strategy for that matter. The idiom "timing is everything" is particularly applicable for the forex market. Let's start by explaining what international date line is, which is the IDL. The IDL is an imaginary line on the surface of the Earth which outlines the border or boundaries between one day and the next day. This line is the reference point for world's time zones, which were created to ensure a common time system. Okay, so here we are looking at the table, the 24-hour markets in South Africa. Some forex trading sections overlap, so they are both open at the same time, and you will find these are some of the busiest times in your trading day. So this is a 24-hour time slot. This is South African time. So as you can see here, that the first one, which is in red, is the Sydney Australian session. It opens at 12 and it closes at 8 a.m. But you can see that the second one, which is the Tokyo or the Japan session, opens at 2 a.m. and closes at 11 a.m. So these two, they overlap, and then we move on to the third one, which overlaps with the second one, which is the London or the England session. It opens at 10 and it closes at 7 p.m. So this is, as you can see here, this block here, there is highlighted in dotted bold dots. It states here that this is the best time to trade because the London is the busiest session. The London is the busiest session of them all because of the New York's stock exchange. So you can see that the Japanese overlap, the Japan overlaps with the London section from 10 to 11 because the London opens at 10 and Japan closes at 11. And then we move on to the fourth one, which is the New York or USA. It also overlaps with with the London section from 3 p.m. to 7 p.m. Because the London closes at 7 p.m. And then the New York is open from 3 p.m. to 12 p.m. So, guys, that's it for today's session. If there's anything you do not understand in terms of the lesson number 2, introduction, please leave a comment, and then I will answer that question accordingly. But yeah, that's it for lesson number 2. Thank you, guys. Peace out. Keep well.